Welcome to the Property Couch, where each week you get to listen to two of Australia's leading property experts as they share with you the insider's guide to property investing.
Bryce, Holdaway, Ben Kingsley, the Property Couch, which is your guide or your insider's guide to property investing. How are you, Ben?
Good morning, Bryce. How are you?
Very well, thanks. Now, we've had a busy week together. We spoke this week down in Warrnambool. We've got a presentation we do for the certified practicing accountants, and we've been doing that all around the country. And that was how to create a passive income through residential real estate. But one of the interesting things is we spent 3.5 hours in the car chatting on the way to Warrnambool there, 3.5 on the way back. And one of the things
solving the world's problems.
We did solve a few, didn't we? But one of the things you got called by journalists and they asked you a few queries and questions about property. And one of the things that I wanted to talk about today is you made a comment to her about regulation's important when it comes to property investing, but you said even more important or a further layer on top of that is education. So that's what I want to chat about today to the listeners. And what were you talking to the journalist in particular about there, Ben?
Yeah, so the background of that particular interview from the journalist was around self-managed super funds and the current conversation that's being held around borrowing arrangements. So self-managed super funds can actually borrow money, not directly inside the fund itself. What they can do is they can use a limited recourse borrowing arrangement. And so the Murray review was talking about potentially limiting that. And I thought it was just a bit of a political football for me in terms of there's a bit of an agenda behind the scenes around that, around the retail and industry funds potentially seeing people move out of their self-managed or their super fund arrangements and into self-managed super funds. So for me, it was about sort of letting the public know and also letting the industry know that I think when you're talking about trying to just blanket ban something as a means to so-called protect consumers, well, how about we start with education first? I mean, trustees of self-managed super funds have a responsibility to themselves and to the fund, and they're trying to create a self-funding retirement. So my view, which has always been pretty strong to the consumer environment, is we need to educate them around what makes for a good investment as opposed to what makes for a dud investment. So that was my message. So don't go out and give me a blanket ban. Let's be sensible about this. Let's produce some data to say that, hey, guess what? Not every property that's going to be bought now, especially in the frenzied market that we're seeing in Sydney and there's a bit of frenziness in Melbourne, that there's some people that are going to lose some money. So they're going to buy some duds. And so that was more to the point to sort of say property is not a given. Not every property is going to, give us that end result that we're looking for. Some are going to outperform others. So let's inform the marketplace about how that is, and let's not just put a blanket ban in there and go forward with that. So that was my rant, I suppose.
Yeah, look, I think there's a lot of gold in there for the listeners because ultimately, I'm in the marketplace buying every day on behalf of clients, and at any point in time, most of the properties that I see don't make for a good property investment. So I think that's a really critical message that you're talking about there. So I kind of think that I try to think of an analogy during the week. I was driving down Williamstown Beach the other day, and beautiful little spot, great little strip along there that would be ideal for hoons to come and drive their car. So they could put some signs up on.
Are you a former hoon yourself, bro?
Well, I sort of
enjoy the
reformed hoon, but
enjoy a little power under the bonnet.
No, but the point is this: they could put some signs on the side of the street that says $200, $500, $1,000 fine if you're caught speeding, which is effectively the regulation argument. Or they could think a little bit more outside the square, and what they've done is they put all this traffic calming, these dirty, great big speed humps that are so annoying that those hoons won't even want to go near that street, despite if they weren't there, how good it would be for them to do that. And I kind of think that is a really long bow drawn for property investors because it's kind of the carrot or the stick. You can sort of whack all these regulations in, and make no mistake, we're all for regulation, some minimum standards for anyone who's advising with property. But ultimately, instead of giving them more rules, giving them better information to make better decisions, i.e. put the traffic calming in place so they self-regulate. I think that's really the message.
Oh, it is. And I mean, there's some marketeers and some people who give property advice. I wouldn't call it advice, try and sell property. And they actually believe So the selling person actually believes it's a good investment. So they've gone through some type of training course from the company that they work for, and they're brainwashed into the concept that this is going to be a good investment. So they're actually not thinking that they're giving bad advice to the consumer. They're not coming from a traditional financial planning or accounting background where you should be conservative, you should be worried about protecting money. They're believing the sales pitch from their managers and the people who are training them up to actually sell this stock. And that's the danger. So yeah, education in both parts. We're talking about consumers being educated, but from a Pippa's point of view, if I can put my Property Investment Professionals of Australia hat on, what I'm talking about there is you want to be dealing with people who are qualified to give that advice, not just someone who's wearing a nice suit who has all of the training for the rebuttals about, I'm a bit concerned, no, so when you hear this from a consumer, you say this. That's a training, that's a sales aid, it's not doing anything in terms of giving the returns. And that's so there's a really powerful message for the industry about training up and getting better educated, but for consumers to also know that who they're dealing with and what sort of advice they're getting versus, getting a sales pitch.
I agree, and because the feedback cycle is quite long in property investment, isn't it? Because if someone is doing what you've just said, and they've gone through that cycle, and they've let's say instead of advising, they've convinced someone to buy a property, they don't really know the outcome of that decision for 4, 5, 8 years down the track, and long past when you've forgotten about what the advisor said to you, isn't it? It's not like you buy a share today and you get immediate feedback in the paper tomorrow or looking online to see what the stock price is. With real estate, it's really hard to get immediate feedback.
Yeah, it is. And obviously the science of investing in the right locations gives us some indications of that. So, an example would be Sydney at the moment. We think that the prices being paid in Sydney are going to be the same prices that get paid in 2017. Now, so if you're going to get into that market, you've got to be prepared for basically flat growth, and you should be worried about the fear of missing out. This is a typical mindset that people go through, whereas we know historically that some of these prices are going to be given back. So in terms of the advice we'll be giving to the listeners is you need to go into marketplaces that aren't at the peak of the market, that they're actually coming into the beginning of the upturn in terms of what they're doing. So buying counter-cyclical, and that takes a bit of confidence.
Absolutely.
Because it's the great Warren Buffett saying, be greedy when others are fearful and be fearful when others are greedy. So that's the message, and it's a really good message to put out there, to the listeners.
So do you think then, because that's a really good message, that Warren Buffett saying is really timely. I mean, what is your message to investors in this country right now, in the two biggest cities of Melbourne and Sydney? What's your education message to them?
How long have we got?
Well, we'll give it a go.
All right. So traditionally, Melbourne and Sydney are still the best marketplaces in Australia because they're our international cities. They attract the multinational providers, which gives us the bigger incomes. And there's a very strong correlation, and we'll do another segment on this, but there's a very strong correlation between income and property prices. And we'll talk more about human interest, human behaviour, at another time. But coming back to that point, so when you've got a frenzied market, the really quality assets have multiple buyers on them. Now, when we're buying for investment returns, we don't want to be caught up in that frenzy, because at the end of the day, we're going to be paying a premium that will settle itself down later on. When we see that type of market, we don't go for what we call the scarce diamonds or the beautiful character homes or the Art Deco apartments. That's not the time to buy them. The time to buy them is when the market's depressed, when it returns back to a buyer's market as opposed to a seller's market. So what we'd be looking for in the bigger markets are townhouses, maybe 5 to 8 to 10 years old, in the right pockets that may not necessarily have that presentation that has that strong beautification of it, or it's a character asset, but it's going to perform really well from a yield point of view, and it's going to get the drag up value of the area. That's the stock that we'd be buying now. So we turned off the tap on buying those period assets probably about 9 months ago in Melbourne and probably about 15 months ago in Sydney, because there's just too much heat on them. So that's the message for those markets. Yet when you go into other markets like Brisbane, we're not, we're still seeing some good results in the housing market, but we're still able to compete on a level playing field, and we think there's a lot more upside in terms of double-digit growth in that marketplace. So that's that's a broad message in terms of how we'd view the market. When it comes back again in Sydney and Melbourne, we'll be coming back into those markets in 2017, 2018 and buying those blue chippers.
Yeah, no, I agree. Look, I mean, it's very difficult to talk too specifically when you're asked a broad question about Melbourne and Sydney, because we know that there's hundreds of submarkets. But traditionally, there's a couple of things that we see as overriding principles and takeaways for the listeners. Is one, we're very strong advocates of established property over new, and particularly in Melbourne. Right now, I think people should approach with huge caution if they're thinking of buying something brand new in this city. I've recently bought a property for a client in an inner western suburb of Melbourne for $412,000, and it was getting 4.25% yield. And the ongoing return of that property has been over a long period of time. Because it's established, I can actually backtest what the properties have actually done. And I could see that it's compound growth well in excess of 9% compounding growth. So the fact that at $412,000, below the median price for real estate in the city, for me, made for a very good investment for that investor, despite some of the sentiment that actually exists in the city. So again, it's about understanding localised areas and the types of property that we're chasing.
Yeah, and the takeout for me in what you're saying, Bryce, is you're focusing under that median. So again, another little strategy in a heated market when we still want to get properties in that particular market is to buy 10, 15, even 25% below median and get that confidence score around, the value of the asset growing. I mean, the intergenerational report that was released yesterday by the federal government had a prediction of 9 million more properties to be built by 2055.
Wow.
So now we're at about 9.6 million. We're growing at around 160,000 new dwellings a year. 9 million more to come. So medium to longer term, we're super excited about the prospects for wealth creation through residential property. It's shelter. It ticks all the right boxes. It's a really good point though. The message for today is educate yourself, work with smart professionals, because a lot of people who try and do it themselves just simply can't compete with the resources that some businesses have. We've got full-time people in our business that are crunching, millions of data points, trying to detect early entry levels of suburbs and local government areas. We're overlaying that with demographic data. We then have, a software program that allows real estate agents and valuers exclusive access to historical data of sales that the average punter doesn't get.
No.
So it's an unfair marketplace. The same sort of thing I'd be saying is if I was a research analyst inside a managed fund and I got to do a tour of BHP's facilities and they opened the books to me better than, that. Whereas if I'm an independent person, I'm sitting there reading their financials. How am I to know that I don't have that advantage? So, you rely on those professionals, but everyone thinks that property is, there it is. It's physical. I can touch it. I know property. Yeah, I can do a good job. And there's hundreds of thousands of dollars of lost potential profit and returns coming that way. So, we'll talk about that another time as well.
Yeah, because you talk about being an unfair marketplace. It's one of those deceiving marketplaces, isn't it? Residential real estate is the only investment market in the world not dominated by investors. And I think that can be a real challenge. It's on the positive, it means that people got confidence that they should actually use that as an investment vehicle. On the flip side, I'm the first to admit I'm not the greatest when it comes to equities or shares. And if someone isn't involved in building business every day, they can actually just acknowledge, okay, shares is the domain of the fund managers, of the stockbrokers. It's not for me. If I'm not involved in building a business, that's for other people. So they can automatically see this mental shift between their ability and that investment class. But the fact that we live in these properties all the time gives us sometimes this uneasy confidence that we already know it. So there's three filters that we always talk about. It's got to be investment grade, it's got to have some form of scarcity, and it's going to have some form of owner-occupier appeal. And we've done a series of webinars recently that, if anyone's interested in those, they can go to the Property Couch and leave some details, and we'll find out how to get those to you. But one of the questions we got from those webinars is, what do you think about student accommodation? And that's a really interesting question they asked. But if you overlay those three filters of scarcity, investment grade, and owner-occupier appeal, in our view, student accommodation fails that number one test of owner-occupier appeal.
It so does, Bryce. I mean, one of the big things we need to understand is that investment grade is not investment stock. I mean, developers build investment stock. Investment stock is student accommodation, is holiday letting. It's that type of thing. And obviously mass-produced apartments and those type of things. They need a level of investors coming into those markets. So don't confuse investment grade, which has underlays of owner-occupier appeal and lifestyle appeal and all those types of things, versus investment stock, which is, I'm trying to get volume sales of people to basically lose money.
If you didn't understand that, I suggest you rewind 30 seconds and listen to that again. That is just gold. Investment grade versus investment stock. The theme of today is about education versus regulation. Understanding that simple concept then that Ben just talked about how do I identify what makes for it to be investment grade versus just anything that I can invest in. If you understand that, you've got most of the game won there. So, Ben, 16 minutes already. We said we're only going to go for 15 minutes. So,
no, I do love it. I do love talking, don't I?
Mate, you love talking. You've got lots to share, and I think that's the exciting thing that we've got for the Property Couch. So there's a couple of things to our listeners. If you've got a question or a query that you'd like Ben and I to discuss in any of these podcasts, please head to thepropertycouch.com.au. Leave us some feedback, leave us the details of what you want us to talk about, and we'd be more than happy to talk about that in an upcoming podcast. And you can also go to the iTunes store and leave us a 5-star rating, which will definitely help us send the message out to people, because really the Property Couch is all about giving you the insider's guide to property investing. So until next week,
arrivederci.
Arrivederci. Good weekend, folks.